Welcome to this explainer. Right now, we're sitting right in the middle of a massive multi-trillion-dollar AI gold rush that is just sweeping the globe. We're looking at a technological and financial phenomenon that's completely reshaping markets, changing how we manage our money, and frankly, setting up some of the largest public offerings in human history. But if we look beneath the surface of all this skyrocketing hype, there are some very real and pretty concerning financial realities that every single investor needs to understand. Okay, let's just dive right into this. Imagine for a second handing over the keys to your financial future, your budgeting, your portfolio, your life savings, to an artificial intelligence. It sounds completely like science fiction, right? But it's literally happening as we speak. OpenAI is actively piloting a finance-focused feature for ChatGPT where you can connect your bank and investment accounts directly to the platform for tailored advice. At the same time, platforms like Robinhood are signaling a massive ramp-up, announcing they're going to soon allow users to trade entirely through AI agents. So this AI takeover of personal finance, it isn't some distant future possibility, it's our current reality. So here is our roadmap for today. First, we'll hit the AI finance revolution. Second, the trillion-dollar IPO race. Third, the AI profitability problem. Fourth, China's cheap AI shortcut. And finally, Section 5, the retail investor trap. We're going to connect the dots all the way from that chatbot on your phone right up to trillion-dollar global market forces. All right, Section 1, the AI finance revolution, promise versus practice. You know, over 200 million people are using ChatGPT every single month, and a whole lot of them are asking it for stock picks and retirement planning. And this brilliantly illustrates the massive gap between what AI promises and what it actually delivers right now. On the promise side, it's incredible. A standalone financial plan from a human advisor can easily run you thousands of dollars, which effectively locks out everyday people. AI advisors democratize all of that, giving you 24/7 access to in-depth portfolio reviews, no matter what your asset base is. But the reality? It is highly, highly risky. These large language models hallucinate. They confidently just make things up, like failing a fifth-grade spelling test or bizarrely calling themselves Make a Hitler in prompts. But more importantly, an AI is not a registered financial advisor. It has zero fiduciary duty to you, absolutely no duty of care. If it hallucinates and tells you to dump your life savings into some terrible stock, there are no legal protections for you, none. Moving right along to Section 2, the trillion-dollar IPO race, cashing in on the hype. So while everyday retail investors are asking AI for budgeting tips, Wall Street is scrambling behind the scenes to cash in. And to understand why there's such a mad rush, you really just need to know one staggering number: $600 billion. That is OpenAI's projected compute spend by the year 2030. These AI models require an absolutely unfathomable amount of money to train and operate. They're burning through cash at historic rates, and to keep the lights on, they desperately, desperately need public cash. And this cash desperation has kicked off basically the mother of all IPO races. We are looking at 3 massive initial public offerings that are set to totally redefine the market. First up, we've got Elon Musk's SpaceX, where the AI segment Grok is driving the vast majority of their capital expenditures. Then you have Anthropic, the company behind Claude, which is filed confidentially. And of course, OpenAI, which just filed its S1. Combined, these 3 behemoths are expected to raise more money than every other US IPO put together since at least 2022. But here's the catch. The expectations baked into these valuations are almost absurd. Take SpaceX, for example. It's hitting the market with a price-to-sales ratio of over 90 times. Just to put that into perspective, highly profitable, money-printing tech giants like Google and Meta, they traded around a 10 times multiple. SpaceX's AI segment only grew 12.5% recently, yet its prospectus reads like a sci-fi novel. They're talking about Mars colonization, asteroid mining, and in-orbit data centers. The market is pricing these companies based on absolute, flawless perfection and total world dominance, not on their actual current balance sheets. Which brings us to Section 3, the AI profitability problem. Let's call this the restaurant analogy. We absolutely have to talk about the underlying economics here, because right now the fundamental business model is honestly kind of broken. Think about how this compares. For the last 25 years, tech investors have been trained on the traditional software model, right? You spend the money to build Microsoft Excel once, and then every new customer who downloads a copy is basically pure profit. The costs are fixed. But AI doesn't work like that at all. AI is much more like a restaurant. Every single time you ask an AI a question, it's eating up electricity and wearing down insanely expensive chips.
the cost increased linearly with revenues. So essentially, the restaurant loses money on every single meal it serves, and its genius master plan to finally become profitable is simply to serve more meals.
And we are definitely not talking about small losses either. In 2024 alone, OpenAI burned through a jaw-dropping $20 billion in cash. Their margins are actually getting worse as they scale up because every new, smarter model costs exponentially more to run than the last one did. Corporate America is paying these massive subscription fees for a technology where the actual return on investment can't even be accurately measured yet. So the crucial point is this. If this bubble is going to burst, the market isn't going to sit around waiting for these companies to officially admit failure. Here's what you actually need to watch. According to the data, the market is going to react the second the underlying story changes. Watch for hyperscalers, your Googles and Microsofts, pulling back on their capital expenditures, or CapEx. Watch the data center debt markets. There are trillions of dollars in data centers being planned right now, and eventually those debt markets are going to tap out. And finally, keep a close eye on bond market credit spreads. Right now, they're sitting at these historic, very calm lows. But bond investors, they only care about getting paid back. If credit spreads suddenly widen, it means the fear of default has officially arrived.
Moving to Section 4, China's cheap AI shortcut, the open source threat.
Now, what's really interesting here is that even if you completely believe the profits are coming, there's a massive, unexpected global disruptor at play. Just think about the sheer difference in capital output for a second. The United States is spending roughly 3% of its entire GDP on AI this year. We're approaching $1 trillion. China, on the other hand, is spending just 0.6% of its economy. The US is outspending China by almost 10 to 1. But despite spending practically pennies in comparison, Chinese AI models are actively filling up the top spots on global performance leaderboards. So, how is that even possible? Well, the answer is a process called distillation. Instead of spending billions teaching a massive AI model from scratch the hard way, Chinese developers are taking a brilliant shortcut. They're training smaller, hyper-efficient open-source models by basically having them copy the homework and the answers of the wildly expensive American frontier models. The US spends billions doing the hardest research in human history, and China just compresses those results into cheaper models and gives them away for practically nothing. And just think about what this does to pricing. A developer recently ran the exact same coding task through Claude Opus, which is a top-tier US model, and GLM, a top Chinese open model. They both took about 5.5 minutes to finish the job. But the US model cost $2.33, while the Chinese model cost 31 cents. It's 7.5 times cheaper. You simply cannot make back $1 trillion US investment if your competitor is giving away 90% of the quality for 10% of the price. It completely destroys the future profitability narrative that Wall Street is banking on right now. Which brings us to our final section. Section 5, the retail investor trap. Who holds the bag? When these massive tech companies are burning billions of dollars and facing intense overseas competition, who is actually going to foot the bill? Increasingly, the answer is everyday retail investors, acting as what Wall Street charmingly calls exit liquidity. Take the SpaceX IPO again. They opted to reserve up to 30% of their shares for retail investors, compared to the typical 5 to 10%. Brokerages literally lowered their capital requirements from $500,000 down to just $2,000 to get smaller investors in the door. And while this is always pitched as democratizing access, it's also a fantastic way for early private insiders to cash out their shares at the very top of the hype cycle, transferring all that immense risk directly onto the public. And how exactly are they getting the public to buy in? Through a highly questionable ecosystem of online promotion. We are seeing a massive rise in these finfluencers, aggressively pumping sketchy, zero-revenue companies to their audiences. Recent investigations have actually uncovered platforms like Polymarket secretly paying creators to promote prediction markets without disclosing the sponsorships at all, even having them place fake bets. We're even seeing companies bypass real human beings entirely, using artificially generated AI avatars to run promotional ads for their stocks. It's wild. And the regulatory oversight here is alarmingly weak. A staggering statistic from the CFI Research and Policy Center found that only half of influencer promotions on social media contained proper disclosure. Just half. That means if you're watching a video telling you to buy a hot new AI stock or some related infrastructure play, there is a literal coin flips chance that the person talking to you is secretly being paid to pump the price up. So how do you actually protect yourself in all this? Here is your action plan. First, if you are going to use AI for financial planning, treat it with immense skepticism. It's a tool, it is not a fiduciary. Do the math yourself. Second, Rigorously ignore finfluencer stock pumps, especially for companies with absolutely no revenue that are just trying to ride the AI wave. And third, if you want to know where the AI market is truly heading, stop listening to the hype. Start watching corporate CapEx spending and the bond markets. Because when the big money stops spending, the music stops. The AI technological boom is very real, but the financial mechanics supporting it are stretched to the absolute limit. As we watch these trillion-dollar companies scramble for public cash over the next few years, you really have to look at your own portfolio and ask yourself, are you truly investing in the AI revolution, or are you just paying for someone else's exit? Thank you so much for joining me for this explainer, and definitely stay sharp out there.